The market is celebrating a consumer confidence number that's still near the worst in the history of this survey. And the data it's built on is already stale. By the end of this video, you're going to understand exactly why the University of Michigan's June sentiment beat is not the green light that the bulls think it is, what the sub-data says that nobody's talking about, and what it actually means for what Kevin Warsh does Tuesday, and what happens to your portfolio this summer. On Friday morning, the University of Michigan released its preliminary June 26 consumer sentiment reading. The headline number, 48.9. That beat the consensus estimate of 46.0. It came in above last month's reading of 44.8. And the market absolutely ran with it. Equities ticked higher. Commentators talk about resilient consumers and green shoots. Mainstream media spent the better part of an hour asking whether the worst is behind us. I want to give you the honest answer to that question. And the honest answer is, well, probably not. Let me show you exactly what's inside this number, because the headline is doing a lot of work to hide what is actually in there. If you like this type of content, please click like and consider subscribing. It's important to be in the know, and this is exactly how you do it. Now, let us start with the historical context, because if you don't have this, 48.9 sounds like a recovery. Before the 2008 financial crisis, University of Michigan consumer sentiment ran between 85 and 100. That's the baseline for a healthy American consumer. During the depths of the Great Recession, the index bottomed out at around 55. During COVID, it crashed to 71 before it recovered then. We are right now sitting at 48.9, which is below the Great Recession trough. This is not a recovery. This is a historically depressed consumer who ticked up 4 points from an even more historically depressed level. The market's celebrating a 49% on a test whether a passing grade is 85. And for the year-over-year crowd, this print is still 19% below where we were a year ago. 19% below. It is 13% below earlier this year, January 2026, and it is 28% below the same month in 2024. You don't put up numbers like that if the consumer is healing. You put up numbers like that if the consumer is treading water and happen to be getting a brief break from one of the things that was drowning them. And that is exactly what happened. The University of Michigan told us exactly why this number beat. The improvement was driven by a temporary dip in gasoline prices during the early part of the survey window. Lower income consumers showed the biggest jump, precisely because gas makes up a larger share of their household budgets. So when the pump price drops even a little, they feel it first. The University of Michigan was not subtle about this. They said it directly. The gasoline relief is what moved the number. Now, here is where you need to pay very close attention. And I'm going to say this slowly. The survey interviews were conducted between May 19th and June 8th. The data closed on June 8th. On June 11th, 3 days after the survey window closed, the Bureau of Labor Statistics released the May Producer Price Index. That PPI report showed gasoline prices at the wholesale level surging 23.4% in a single month, the largest annual wholesale inflation print since November 2022. At 6.5%, my friends. The same gasoline relief that drove the sentiment beat is already reversing in the supply chain. Consumers just don't know it yet. The survey doesn't know that yet. By the time the final June reading comes in, this could look very, very different. It's certainly going to look very, very different when PPI moves through the system and ultimately gets into the CPI, the consumer numbers, this by mid to end of summer. The beat is built on a gas price dip that the wholesale data says is already over. But here's the shadow data that really matters. You know I love the shadow data. And this is the one that the financial media is just not picking up on Friday. Embedded in every University of Michigan release are two inflation expectation readings. The 1 year forward expectation and the 5 year forward expectation. The 1 year came in at 4.6%. That was down from 4.8% last month. The market is treating that as pretty good news. It's slightly less bad news though. 4.6% one-year inflation expectations means consumers believe prices will keep rising significantly for at least another year. That's not confidence. That is resignation. And that actually is a really dangerous thing, because once consumers accept inflation, we could have a real problem. But the number that really matters, the one that the Federal Reserve watches most obsessively, is the 5-year inflation expectation. That number came in at 3.4% this month. That was down from 3.9% in May. The market's celebrating that decline. And yes, a drop from 3.9% to 3.4% is directionally better. But here's the context that makes that number dangerous. Through all of 2024, the 5-year inflation expectation ranged between 2.8% and 3.2%. We are still well outside that range, in case you didn't notice. The Fed considers long-run inflation expectations anchored when they say below roughly 3.2%. At 3.4%, in case you haven't noticed, they are not anchored. They are drifting. This is critical, and I want to explain why. When consumers believe that inflation 5 years from now will be high, they behave differently. They demand higher wages. Businesses raise prices to cover those wages. Landlords build future inflation into leases. The expectation becomes self-fulfilling. This is why the Fed does not just watch current inflation. They watch what consumers believe about future inflation. And right now, consumers believe that 3.4% inflation is the new normal for the next 5 years. That's not a number a central bank can ignore easily. That is a number that keeps the Fed exactly where it is. Let me give you a real world frame for this. Imagine that you're trying to convince someone that the house is not on fire, and they look at you and say, well, I still smell smoke, but maybe a little less smoke than last month. That's what 3.4% 5-year inflation expectation sounds like to a central banker. Not the fire's out, just maybe a little less smoke. That's not enough evidence to reach for the rate cut lever, trust me. So let us connect all of this to what happens next week with the Fed meeting. Kevin Warsh chairs his first FOMC meeting on June 16th and 17th. Going into the Friday morning number, the market was already pricing in a 33% probability of a Fed hike by December. With this sentiment beat, some traders will flip the narrative completely, saying the consumer is healing. The Fed, they can ease, maybe even signal a cut. Here's what they are missing. Warsh is not going to look at 48.9 consumer sentiment and call it healthy. He's going to look at the 3.4% 5-year inflation expectation, and he is going to call it unanchored. He's going to look at PPI at 6.5% and CPI at 4.2%, and know that the inflation fight is not over yet. He's going to hold, my friends, not because he wants to, but because the data, all of the data, does not give him permission to move at all. The sentiment bounce, it's very real. I'm not saying it's fabricated. Consumers genuinely felt a little better when gas was cheaper, and that's good and completely expected. That's human and it's rational. But financial markets are supposed to look past the current feeling and price the forward reality. Forward reality is that wholesale gasoline is already running hot. 5-year inflation expectations are unanchored. The survey data is 3 days stale, and the 3 days since it closed contained the worst PPI print in nearly 4 years, and an ECB rate hike, dare I say, into near recessionary European growth. The market is trading the feel-good headline of a data point that is already out of date, my friends. There's one more layer here, and it's the one that should keep every investor completely honest. The consumers who drove this beat, lower income households, are also the most exposed to what happens when gasoline prices bounce back. The same sensitivity that made them feel better when gas dropped will make them feel significantly worse again if and when it rises again. And the wholesale pipeline says it's going to rise again. So the population that produced the upside surprise on Friday morning is the population most at risk of producing the downside surprise in the next reading. Here is where I want to leave you. A beat is a beat. 48.9 is better than 44.8, and I will give the bulls that. And I'm a bull, but context is everything in this business. 48.9 is below the Great Recession trough. The beat was driven by a gasoline price dip that wholesale data says is already reversing. The 5-year inflation expectation is still at 3.4%. That's outside the Fed's comfort zone. The survey window closed before the biggest inflation data of the week hit, and the consumers who led the bounce are the same ones who will feel the reversal the hardest. The market is trading the headline again. The headline is not the full story, though. So your truth bomb for today is this. The University of Michigan beat means the American consumer felt slightly better about a gas price that wholesale data says has already reversed. And the 5-year inflation expectation sitting at 3.4% tells you everything you need to know about whether the Fed has permission to ease next week. Join me every day for Wall Street Truth Bombs, where I drop them right here before the market figures them out.